In this video, I'm going to explain in detail a little bit about the differences between a trader or an investor. If you're a beginner coming into markets, it's often hard to tell the difference or understand the different things that you need to learn. So really the way I see it is there should be one path or the other you want to go down if you're a beginner. So whether you want to go down the trading route, there's certain things that you need to learn, there's certain habits you need to form. If you're going down the investor route, there's also different types of habits and different things that you want to learn. And the easier thing is to go down one path or the other. Don't try and be a trader and investor all in one at the same time if you're new to this. So let's explain what the two are, and we'll go through some of the key differences and the key things that you need to learn depending on which path you choose to go down. Now, don't forget that any advice contained within this video is general only, so it isn't tailored to your particular circumstances, and you need to decide for yourself if it's appropriate to you. Okay, so first up, a share investor tends to buy and accumulate stocks over a period of time till it gets to a point where the stock seems a bit overvalued and they decide to sell. So the investor is really more focused on what a stock's going to do over a longer term period, whether it be months to years. Some investors only care about investing over 10 years plus, right? We know some people that, especially younger investors, are buying for their retirement if they're buying inside their super fund. So, every investor has different goals, different time frames, but typically it's a longer term time frame where they're looking for capital growth, they're looking to collect dividends along the way, and they tend to start small, they add their savings in and accumulate as they go. Okay, so that's one of the key things when I think investor. It's really I'm buying, I'm accumulating the stock over a period of time, and I only sell when something fundamentals change and I don't think that stock can push up any further, or that stock can't grow any more than what it's already grown. Where a share trader is a lot more active and they tend to play the swings and they go long, which means they're going bullish. They think that the share market's going to go up, and then they profit from going short, then they profit from going long. And they're basically trying to profit from every swing in the market. Okay, so as the market's swinging up, this is a bit of terminology you're going to learn. Long means trading the stock in an upward direction. Short means trading a stock in a downward direction. And you can do both in the equity market and in many other markets like commodity markets and the rest of it. But for me, it's about getting in and out frequently, whether it be, some people trade daily, so they're in and out within a day. Some people trade, for a couple of days or a week or a month, right? But essentially what many traders are trying to do is just be in and out quickly and take small profits and keep losses small, right? So it's just a very frequent game of in and out of the market over a period of time and switching directions. So yeah, typically, for me, for instance, my longest trades would go for a few months and that's it. My shortest trades could be 1 or 2 days, right? I don't tend to day trade myself, but I know plenty of people that do. Many of our clients do day trade as well. It depends on, your personal circumstances more than anything that dictates, the time frames that you trade in. You can make trading or investing fit your life, okay? Your lifestyle and how you choose or how much time you choose to spend on markets. So let's cap over this quickly. An investor is going to be less active. They're not going to move their positions around anywhere near as often as a trader. An investor will tend to buy and accumulate over a period of time and look to add a bit of savings in each month or each year to top up their stock portfolio. And only really, buy in on the back of fundamental analysis. So you're analysing, what a company does, their sector, how well they're doing, the potential for growth, how well they're managed. All those sorts of things are more of a fundamental type of analysis to determine when to buy and when to sell. Only time that they use technical analysis in investing really is just to time the entry, right? So try and get a better price. So where with trading, you're a lot more active. You're trading every single day, looking at the market, making decisions on whether to stay in or get out. You're trading long or short the market, which means you don't care which way the market's swinging. You just need to predict which way it's going to swing successfully. You're mainly using technical analysis for entry and exit signals. Okay, so don't do much fundamental analysis in trading. Okay, short term, you're mainly leaning on the technical analysis because timing is everything as a trader. Where with an investor, timing isn't as much a key element as it is picking what it could do over the long term. So you don't care if the stock pulls back 5%, as long as it goes up 30, 40, 50% plus over the following years. So, timing is less important as an investor. Where trading, it's all about the timing. With an investor, typically just buy the stock or hold the stock. You don't need a lot of fancy trading platforms. You can probably get away with delayed data, which is a bit cheaper as well. There's also a lot of free basic trading platforms out there with delayed data available for you. For that type of investor, that's not very active at all. Where with a trader, you really want to start looking at things like derivatives, where you gain a bit of leverage and things move a lot quicker. Leverage means that you can gain high percentage profits or losses from very small movement in the market. Okay, so BHP might move 2% and I can make 30% off a options trade. There's more leverage trades where you can make much more or lose much more as well. So you're just going to be careful with leverage, guys. I'll put that out there. Make sure you listen to some more of our videos and webcasts. Go have a look at our beginners course. We'll talk a little bit more about the pros and cons of leverage. But as a trader, you want to learn derivatives, right? That way you can trade with much smaller amounts of money in the market. It doesn't lock up your capital, and you can keep some of your capital aside for your stock portfolio when you're ready to put that investor's cap on. With trading, you probably want a little bit more of a sophisticated trading platform that has a really good charting engine. You want some extra tools to help you out, keep you alerted with what the market's going to do, or what the market is doing, I should say. But you want alerts, you want a good charting engine, you want something fast and quick, so that way you can make your decisions on the run. A good mobile app is always great as well. That way, if you are on the run and you need to quickly close a position or check a position, you can. So technology plays a much larger role as a trader. Where with an investor, where you want to be spending your money on, if you're going to subscribe to something, is good analyst data. So you want to follow a good analyst that's going to give you the data that's going to save you time in your fundamental analysis. So there's many companies out there, including us here at Emerald, that provide analytical platforms that help you run through stocks, look at them from a fundamental standpoint, and make decisions. So there's quite a few different things you need to think about here. As an investor, you need to become good at fundamental analysis. You need to find good fundamental data, good commentary to follow to help you become more efficient. You save money on not needing live data, you save money on your trading platform, but where you spend that money is on good data. Okay, you really want to have good fundamental information in front of you to make sound decisions. As an investor, you don't have to be glued to the market throughout the day or throughout the week. Some investors I know only check the market once a week. Okay, so you've got a lot more flexibility of when you spend time on this. You can spend your weekends doing your stock analysis, quickly buy some stocks on the Monday, and you won't look at it for another week, right? Trading is a little bit different. Trading, you tend to spend a bit more time in front of the platform whilst the market's open, but you only need 10 minutes here, 10 minutes there, right? So yes, as a trader, you'd be looking at the market every day, but you don't need to sit down and do a lot of really long analysis. Once you become good at technical analysis, the process can be very, very quick. And you may spend a half an hour a day spread out through the day, looking at your trades, making quick decisions on whether to stay in or get out. So it's a different way of life. As an investor, you have a lot more flexibility on how and when you spend the time, because timing is not as critical, okay? And how much time you spend is entirely up to you. The more time you spend often can lead to better results, especially if you spend a lot of that time educating yourself. One way or the other, whether you become an investor or a trader, right? The more time you spend educating, it's not necessarily the more time you spend on the market, but it's more time you spend educating yourself, the better, especially if you're a beginner at this, okay? Often, I have a lot of people say to me, I've got $5,000 to spend on the market, what should I invest in? And I say your education, okay? That's the most important thing here. Okay, all right, but at the end of the day, trader, okay, it's more cash flow. It's about getting in and out of the market, trying to make small profits as you go along. Investing is more about long-term gains, building a portfolio, and building a nice big asset over time, okay, and that's the big difference here. Okay, so I've just mentioned a few things, guys. I'll just reiterate just from an education point of view. We talk technical analysis. So what is technical analysis? What is fundamental analysis? Well, technical analysis basically looking at charts. We look for patterns on the charts. And if those patterns reoccur again, there's a probability that the stock's going to react the same way as it did last time. Okay, so it's a game of probability. You don't get every single trade right following technical analysis. The goal of trading is not to get every trade right, but it's to get more right than wrong, okay? And obviously have a really good trading system to stop you from blowing out those losses, okay? So it's all about developing a sound principle of trading rules or a system that works for you based mainly on technical analysis to get you in and out of the market. So doing a lot of chart analysis, a lot of number crunching. Fundamental analysis, it's very different, right? What you're doing is looking at a company's balance sheet. So you want to analyze the company. What do they do? What's their industry that they're in? Get into the macro level of things. What's the future outlook? Okay, if they've got a good future outlook of growth, or they deliver a really good, consistent long-term dividend, there might be many different reasons why you buy something long-term, but typically you're doing it for a fundamental reason, doing some form of fundamental analysis like that. I also talked a little bit about derivatives. So derivatives is a financial product. They derive their price from an underlying value. You know, in this case, you might use BHP as an example. There's derivatives on BHP. The value of those products, the value of those derivatives go up or down depending on what BHP does. Okay, so you know, there's all sorts of different products you can trade this on. You can trade this on commodities. You can trade derivatives on currencies. There's all sorts of different underlyings you can trade, right? Whether it be equities, anything, right? There's so many things to choose from out there. Typically, we stick to equities, guys. We do a bit of commodity trading, things like that, a bit of currency as well. But the main ones that we like to use are exchange-traded options and mini warrants on the Australian market. You know, once again, if you want to learn a little bit more about those, there's plenty of content on our YouTube channel. You know, there's plenty of content on our website. Just have a look around, and there's plenty of education that we deliver on the back of that. Quite a few really good webcasts as well. All right, but derivatives, that's a financial product. We use that for trading. We use those derivatives to go bullish or bearish the market. It gives us a lot more flexibility on how we profit from the market. There's strategies using exchange-traded options where you can actually trade sideways market, right? So I don't actually have to get the direction right at all. As long as it stays above a certain level, I'll pick that level, then I can make a profit, you know, over a period of time. So there's it just opens up the flexibility of how you can trade the market by using derivatives. Always warn everybody though, they are a leverage product. You got to treat them with respect. You must educate yourself on how to use them effectively, or else you can lose a lot of money trading derivatives. So don't go into this blindly, guys, right? Get educated, okay? Spend the money, spend the time getting educated on this before you go in and do any trading using a derivative, okay? Okay, so we'll leave this video here. Thanks a lot for jumping in. Take care and bye for now.